So the first topic that we're going to cover is the audit of a deferred tax. So firstly, let's understand what is deferred tax. Let's quickly recap what is deferred tax, and then we will look at this particular question and write down how we gonna approach the audit of a deferred taxation, if at all, if that comes in our scenario for our examination. So when it comes to audit of deferred tax, first let us understand what is deferred tax. So deferred tax is an accounting measure, and this is under the standard of IAS 12. So as per IAS 12, deferred tax is nothing but an accounting measure. So it is an accounting measure to match the tax effects of the transaction with their accounting impact, to match the tax effects of the transaction against their accounting impact. Okay, so depending upon the jurisdiction your company is working, the taxation rules will be different. So even though you are following an IFRS standard and you are following a specific method of accounting, the tax might tell a different rule with respect to the same transaction, because of which how the assets and liabilities are valued in the balance sheet versus as per tax how they are valued might differ. And hence we will create a deferred tax on that. And deferred tax is just to adjust. Either we create a deferred tax asset or we create a deferred tax liability. Right. Now we are creating a deferred tax liability because today we might pay less tax, but tomorrow we might end up paying more tax. So then for tomorrow's effect, we might create a liability. Deferred tax asset we create, maybe today we are paying more amount of tax, but today we are paying more amount of tax, but tomorrow we will pay less amount. So we will create a deferred tax asset because tomorrow we don't have to pay that much amount of tax. And these accounting measures are specifically for those transactions which are of temporary in nature. So the deferred tax are an accounting adjustment which are created only for those temporary differences, those transactions that creates temporary differences between accounting and tax, between the accounting and tax. So temporary difference means over a period of time the difference will not exist, it will go away. That is called as a temporary difference. Now, as per IAS 12, deferred tax, as I told you, a liability is created thinking that today we are paying more tax, less tax, so tomorrow we might end up paying more tax. That's a liability. So we have in deferred tax two kinds of items, which is a deferred tax asset, I'm going to call it as DTA, and a DTL, a deferred tax liability. Deferred tax liability we will create because we are paying more tax, we are paying less tax today, but might pay more tax tomorrow when the difference are removed. So when these tax temporary differences are removed, then we might end up paying more tax tomorrow. So we pay less tax today, but might pay more tax tomorrow when the differences are removed. When it comes to deferred tax asset, we might end up paying more tax today, but less tax tomorrow when the differences are removed. So just the opposite of the deferred tax liability. Less tax tomorrow, more tax today. Now when it comes to the deferred tax liability, we are anticipating that we will have a tax liability tomorrow. So hence we are adjusting the tax today. But when it comes to deferred tax asset, we will say we might end up not paying more tax tomorrow. So we are creating an adjustment, adjusting the tax for today. Again, same concept. Today. Since less tax tomorrow. Since more tax tomorrow. Okay. So as I told you, deferred tax is created only for those differences between there are temporary differences. Only for a temporary differences we create a deferred tax impact. So when it comes to temporary differences, the temporary differences are the difference between your carrying amount of the asset carrying amount of the asset or liability against the tax base. So carrying amount of the asset or liability against the tax base. Like carrying amount of the asset or liability is the value as per books. Like as per your accounting rules and regulation, what is the value? Tax base is the value as per tax. So as per tax, what is the value you follow? What is the value? That is called as, tax base. And there are two types of temporary differences. One is taxable. There is taxable temporary difference, and there is deductible temporary difference. So taxable temporary difference it will lead to creating deferred tax liability, whereas deductible temporary differences will lead to creating deferred tax asset. So deferred tax liability versus deferred tax asset. These are the two types of differences. An example where your taxable temporary difference could occur is where your depreciation as per tax is greater than as per books. So as per tax, if you are paying more depreciation, then depreciation expense is high. So as per tax, you don't have to pay tax on those depreciation expense. So your tax amount that you have to pay now will be less. So which will lead to less tax you're paying now. But ultimately when the difference goes away, when the carrying amount of the asset as per tax base becomes zero, then you don't have any depreciation to claim. So next year, you still have the asset or liability. You would not have made it zero. You still have the asset or liability, but as per tax base, it is 0. But as per us, it is not 0. As per the books, it's not 0. So during that time, you won't be able to claim tax expense. So then what will happen? You will end up paying more tax. So this is an example of paying less tax today, more tax tomorrow. More tax tomorrow. Whereas in deferred tax asset is the straight opposite example where depreciation as per tax is lower compared to depreciation as per books, due to which you will pay more tax because expense is lower. So more tax today because your depreciation expense is lower, your tax expense will become higher today and less tax tomorrow. Less tax tomorrow. This is called as your deferred tax asset or a liability. So let's try to understand this with a very simple example. So let's take a very simple example. Okay, so let's say that we purchased an asset. Okay, so this is an example. So let's say we purchased an asset with a cost of $30,000 and useful life is equal to 3 years. So depreciation per year will be 30,000 divided by 3, which is equal to $10,000 for each year. So per year it will be 10,000. This is our depreciation per year. Okay, but let's say that so this is as per your books. Okay, now as per tax allows for this particular item, so they accept this particular machinery with same cost of 10,000. But they are saying that the use this thing depreciation should be 50% per annum. So then depreciation per year will be equal to 30,000 into 50%. So that will be $15,000. Okay, so let's say this is your depreciation. Okay, this is as per tax. This is what the tax rule says. For the asset that we have purchased, you have to do a 50% depreciation. You have to remove it within 2 years is what the rules as per the tax says. So now how will we show this? So let's say look at here. Let's say this is as per your books and this is as per your tax. Okay, as per books, as per tax. And this is your difference. Okay, so as per books, you have a cost, okay, which is $30,000. As per tax, cost is the same. There is no difference, 0. Minus depreciation, here it will be 10,000, but here this will be 15,000. So there is a difference of $5,000. Okay, there is a difference of $5,000. Okay, so this is carrying amount year 1. So how much is your carrying amount? $30 minus 10, which will be 20,000. Here it will be $15,000. So the difference is $5,000 is your difference. Okay, 5,000 is your difference for carrying amount on year 1. Now in year 2, what is your depreciation? This is year 1. This is year 2. Your depreciation will be 10,000. As per tax, depreciation will be 15,000. So what happened to your difference? Again 5,000 difference. Correct? 5,000, there is a difference. So carrying amount year 2. Carrying amount year 2, $10,000, and here this will become 0. What happened to your difference? Difference became 10,000. Now how did the difference increase? Because in year 1 you have a difference of 5,000. Year 2 you have a difference of 5,000. Right? So total year added together, this will become $10,000 is equal to 10,000. So that's, let's put it as 3. 1 plus 2 is equal to 3. Now in year 3, what happened? So in year 3, you have a depreciation, which is for year 3. What is the depreciation? 10,000 is your depreciation. There's no depreciation as per books because the carrying amount is 0. Now the 0, this is 0. Now what happened? If you look at here, the difference is in a negative way. Till now difference was positive because tax was greater than books. Tax was greater than books. So 15,000 minus 10,000 is 5,000. Now when it comes to year 3, the difference is gone. Why? Because carrying amount as per books, carrying amount as per tax became 0. So minus 4, this is equal to 5. 5 became 0. So that there is no difference in year 3. So in year 1 and year 2 there is a difference, but in year 3 there is no difference. Now what this difference is? As I told you, in year 1 there is a difference and the difference is going away in year 3, right? By end of year 3 the difference is gone. So hence this is a temporary difference. Is it a taxable or a deductible temporary difference? Is it a taxable difference or a deductible difference? See, as per tax, you are allowed to claim a depreciation expense of 15,000 in year 1. But as per your books, you are claiming an expense of only 10,000. When you are claiming more expense, your profit will be lower, your tax will be lower. But since you are paying less tax today, you might pay more tax tomorrow. So this will become a taxable temporary difference. Same way, this will also become a taxable temporary difference. So how does this impact in your financial statement? Let's look at it. Okay. So let's look at this in your financial statement. So let's say in your statement of profit or loss, you have year 1, you have year 2, and you have year 3. Okay. Before that, let me just calculate the deferred tax impact. So let me just calculate the deferred tax liability. Okay, year 1, year 2, year 3. So carrying amount as per books in year 1 was $20,000. This was $10,000. This was 0. Okay. As per tax base, what is the tax base? Your tax base is $15,000. Okay. So the difference is $5,000. Your tax base was 0, so your difference was become 10,000. Your tax base is 0, so your difference nullifies. So there will be a negative, amount which will knock off all your difference. So this is your taxable temporary difference. Since carrying amount of the asset is greater than tax base, that will lead to a taxable temporary difference. So let's say your deferred tax liability, since it's a taxable temporary difference, it's, let's say, 20%. So in first year, what will be your liability? 5,000 into 20%. So that is 1,000. Second year, 10,000 into 20%. 10,000 into 20% will be 2,000. In third year, okay, what happened? So first year, it will be 1,000 because the difference was 5,000. Second year, difference was 5,000 plus additional 5,000 came in. So your total difference became 2,000. Right. Third year, what happened? Your difference, the entire difference of 2,000 will be removed. Correct? So what will be the journal entry? Debit tax expense $1,000. Credit deferred tax liability of $1,000. In the next year, you have to increase your liability to 1,000. You have to increase the liability to 2,000. So by 1,000 you will increase. So again, 1,000 and 1,000. How can we understand this? This second year it will be 1,000 because look at here. Okay, let me just rub this. Okay, look at this for instance. In the first year, you have a tax difference. So amount is 1,000. Again, this amount is same. The second year depreciation, you have $1,000. So 1000 plus 1000, your total deferred tax became 2000. That's how your deferred tax liability is increasing. So similarly, 1000 this became, and in third year the entry is opposite. In third year your entry will be debit deferred tax liability with respect to 2000 and credit tax expense. You will remove the entire amount. This is how the entry will look like. Okay, this is how the entry will look like. Now the question is, why are we doing this? What is the purpose? Why do you have to do this? What is your purpose? So let's look at this in statement of profit or loss. Okay, let's look at statement of profit or loss. Let us say you have your profit before depreciation. Okay, profit before depreciation, year 1, year 2, year 3. Let us say it is the same. Let's say it's $50,000. Okay, 50,000. Okay, that's your depreciation. Profit before depreciation. Minus, what is your depreciation as per books? Depreciation as per books. Here it is 10,000, 10,000 and 10,000. This is your depreciation. So what will be your net profit? Profit before tax. Before tax will be 40,000 each year. Let's assume this, that every year this is your amount. Now when it comes to your tax, what happens? Tax. You have two types of tax. Let's say one is your current tax and then your deferred tax. So your current tax, which is calculated as a percentage on your profit, and then you have deferred tax. So current tax is a tax percentage based on your profit. Now, do you take 40,000 and multiply 20% and show your tax? No. Do you have to show that as your tax expense? No. Whatever you need to calculate in your tax expense, you will calculate it as close to the taxation authorities as possible. So you will create a separate tax calculation for your current tax, year 1, year 2 and year 3. So profit before depreciation is 50,000. 50,000. And here also 50,000. Minus, you will reduce the tax depreciation. What is your tax depreciation? 15,000. 15,000. And 0. So now look at here. What is your profit before tax? Here it will be 50 minus 15, which will be 35,000. 35,000. And here this will be 50,000. So what is your tax? So your tax amount, tax at 20%. So 35,000 into 20%, 7,000, 7,000 and 50,000 into 20% is 10,000. This is your tax amount. So let's say your taxes first year is 7,000. So see, it's lower, right? So this is 7,000 and here it is also 7,000 and here as you can see the tax amount is 10,000. So in the first 2 years your tax is lower, but in the third year your tax is getting higher. So which means that's what I meant, when you pay less tax today, you might end up paying more tax tomorrow. And for that you are creating a deferred tax impact. So if you look at here, in first year we are creating a deferred tax of 1,000. So 1,000 deferred tax. So total tax will become 8,000. Your total tax will become 8,000 and your profit after tax will be 42,000. Again here you will do what? 1,000. So $8,000 and this will be sorry, 32,000. My mistake, 32,000. 32,000. And here you will reverse the tax. So $2,000, 8,000, and here 32,000. Now multiply 40,000 into 20%. Your tax rate is 20%. 40,000 into 20% is equal to 8,000. So this is the reason we are creating a deferred tax impact. Because as per tax, your tax expense can change, right? 1 year, 2 years it will be same, third year it might be different. But over the period of time, we need to make it consistent. Hence, we create a corresponding entry called as deferred tax. That is the concept behind creating a deferred tax. This is clear? Now, let us look at this particular question and then try to understand what is the problem here, okay, with respect to deferred tax. Now, before we do that, all you need to understand when it comes to deferred tax is these things. One is, if it is for an assets, okay, and if the carrying amount of the asset is greater than tax base, then it will create a taxable temporary difference, which will lead to deferred tax liability. However, if the carrying amount of the asset is lower than the tax base, it will lead to deductible temporary difference, which will lead to deferred tax asset. Whereas for a liability, if the carrying amount of the liability is greater than tax base, it will lead to deductible temporary difference, will lead to a deferred tax asset. Deferred tax asset. Whereas the carrying amount of the asset is lower than tax base, then it will lead to taxable temporary difference, deferred tax liability. Always remember this, because this is what the deferred tax concept is completely purely based on. So let's look at this question, activity number 1, Armstrong. So you are the audit manager responsible for audit of Armstrong, a startup company that is producing sporting equipment for retail market. The draft financial statement for the year ended 31st December X6 showed a profit before taxation of 3 million and a total assets of 11.6 million. So when they give you this data, you are asked to calculate the materiality, because you can calculate the materiality based on profit before tax and compare it against the transaction to see if the transaction is material or immaterial. At year end, Armstrong had a plant and equipment with a carrying amount of 3.6 million. The tax written down value of the plant and equipment was 2.1 million. There was no deferred tax provision in the year, as this is the first year of trade. The financial statement have disclosed a deferred tax provision of 450,000 based on a tax rate of 30%. In respect of the amounts relating to the deferred tax, comment on the matters you should consider. Second, the evidence you should expect to find. So let's now divide this answer into what we learned on the approach is materiality, risk, finally the assertions, and then the audit evidence and the audit procedures. So first let's talk about the materiality. So materiality. Now this comes under the question 1, the matters you should consider, right? So the matters you consider, the evidence is the second point. Okay, so I'm gonna write it here, the matters you should consider. The first one is the materiality. So when it comes to the materiality, whether this particular deferred tax provision is a material one. Okay. So if you look at here, the deferred tax provision, what you need to write is the deferred tax provision charged of $450,000 comprises of 15% of the profits before tax, right? And profit before tax is how much? $3 million. $3 million. Right? Why it is 15%? Because 450,000 divided by 3 million is around 15%, and 3.8% of the total assets. What is your total assets? $11.6 million. So 11.6 million is your total assets, right? So therefore the deferred tax provision is material to the statement of profit or loss and statement of financial position. Right? So that's the materiality that you are going to write. The next aspect is about the risk. What are the risks in relation to the deferred tax? What could be the risk? Risk are nothing but the fear or the risk of material misstatement. What are the possible mistakes the accountant might make while he is creating this deferred tax provision? So the question is whether the deferred tax provision and charge are complete, which means have they considered all the assets they are supposed to consider and all the liabilities they are supposed to consider while creating this deferred tax provision. Second, whether the deferred tax provision and statement of profit or loss have been properly presented and supported by appropriate disclosures. So have the deferred tax provision and statement of profit or loss have been properly presented along with the appropriate disclosures. That's the next one. Then whether the correct tax rate have been used. Tax rate of 30%. What if the tax rate should have been 20%? Then there would be a mistake, right? Whether the deferred tax provision have been calculated accurately. Whether the calculation was correct. That's the next one. Whether the calculation is correct and the calculation what they have done is correct or not is something that next to risk. Right? So M is done, materiality is done, risk is done. Now what is the accounting standards? What does the standard says? What does the standard says? That's what we are we are supposed to write next. So as per the standards. Standards. Okay. So what does the standard says? So standard says that as per IAS 12, if it's possible, then quote the standard if you remember it. Requires deferred tax is calculated at a rate that is substantively enacted and expected to apply when the deferred tax is to be settled. So when the deferred tax is expected to be settled, so if it is going to be in a future rate, then you create a rate, use a rate which is appropriate in future, expected rate in future. You can use that. So you're gonna let's say for example depreciation, the temporary difference of tax days as well as the asset might become same maybe in 2 or 3 years time. So in 2 or 3 years time, what is the rate that we can expect? We can use the rate, but even then the standard for this particular sentence is not very strictly followed. What you can do is you can use a rate which is prescribed as per the tax provisions, like as per the tax, what is the current rate, that is also they are used. IAS 12 requires the amounts is based on temporary differences relating to plant and equipment. The temporary differences relating to plant and equipment is what you are supposed to use, right? That's what the IAS 12 says. Appropriate disclosures are required to be made for items forming the deferred tax provision, right? So you need to make appropriate disclosures, like you can say the total amount of assets or liabilities, calculations and rate used to calculate the deferred tax provision, etc. These are the disclosures that you are required to make. And what kind of evidences you can expect, which is the second point. What kind of evidence you can expect, right? So with respect to the second point, right? So second point, evidences. Okay. One, you can ask for number one, a schedule. So request a schedule of temporary differences relating to plant and equipment agreed to plant and equipment schedule and tax computations. So first you need to request a schedule. Take the total schedule as per the plant and equipment and agree that to the plant and equipment schedule and the tax computations necessarily. Agree the tax rate used of 30% is appropriate as per the tax rules and allowed as per the IAS 12. So ensure that the 30% rate is used is appropriate as per IAS 12. It is allowed. It's not be that it's totally different relating to the what the standard says. Okay, totally different relating to the standard says. Then the next one is that recalculate the deferred tax provision. Deferred tax provision charge of $450,000, right, which is nothing but written down value, carrying amount of $3.6 million minus written down value. What is your written down value? $2.1 million, which is equal to $1.5 million multiplied by 30%, should be equal to $450,000. Whether when you recalculate, is this the same thing that you're getting, right? Then last one is review the notes to financial statements to ensure the appropriateness of disclosures made as per the IAS 12. Whether the appropriate disclosures have been made with respect to the IAS 12 or not is something that we need to check. Okay, so these are the appropriate requirements that we need to meet when we are auditing the deferred tax computations or deferred tax provisions. And if you write all this, then you will be able to score approximately 6 marks.